Buying just 10 shares of ServiceNow stock today will make you a multi-millionaire in retirement. This stock is one of the most undervalued companies I have ever seen in the market, and it has been brutally, and I mean brutally, punished by the SaaS apocalypse, which is a massive fear flooding through Wall Street that companies that rely on software subscriptions are going to be absolutely decimated by the advances in AI technology. And unfortunately for Wall Street, I believe they are 100% incorrect. So ServiceNow just reported earnings, and the stock is down 16.62% in a day. In a day, and I personally have a position in this stock, and I'm hurting pretty bad. For the past year, the stock is down 44%. And over the past 5 years, after a massive run-up, an extraordinary run-up where the stock was almost touching $240 a share, on a 5-year chart, this stock is down 21.7%. Now, the average retail investor may be scared away by a company that has had massive underperformance of the stock market. The S&P 500 is probably up 60, 70% over the past 5 years, and it's at the forefront of the AI revolution. So the average person will look at this and they'll say, why would I buy a stock that is down 21% in the past 5 years and is at massive threat of being completely disrupted by artificial intelligence? And I would clap back and say, this is actually the perfect time to buy the stock. Now, let's go check out their horrible earnings, and we're going to try to figure out why this company is down 16% on a day. And then we're going to do a valuation and figure out when we should actually buy this stock to get a return. So, this is their most recent earnings report. This is their financial outlook. We're going to read this together, and you're going to be shocked by how bad their business has been impacted by artificial intelligence. In Q1 2026, subscription revenues growth saw an approximately 75 basis point headwind from delayed closings of several large on-premise deals in the Middle East due to the ongoing conflict in the region. Let's break this down. What is 75 basis points? 0.75%. Remember, ServiceNow is a company that is growing revenues at 20, 21, 22%. They got a 0.75% reduction in their revenues because of the conflict in the Middle East. So number one, they took a slight hit because of the conflict. And number two, the conflict is basically over. No conflict lasts forever. And that seems like a pretty light hit to their revenue in Q1 for such a serious conflict that is literally almost over. Wow, let's sell the stock. This outlook reflects a prudent, keyword prudent, they're being conservative here, assessment of those geopolitical headwinds on deal timing for the remainder of FY 2026. Okay, but where's the AI disruption? I'm not seeing AI disruption. I'm seeing a slight hit to revenue growth because of a temporary conflict. Sell the stock 16%, eh? Our Q2 2026 subscription revenues growth, Q2 2026 remaining performance obligations growth, that's future revenue, and FY 26 subscription revenues growth guidance each include approximately 125 basis points of contribution from Armis. A portion of Armis customer contracts include termination for convenience provisions, which limit the amount of contract value reflected in remaining performance obligations. So what they're telling you here is that we could potentially see up to a 125 basis point headwind because of the conflict in the Middle East. That's 1.25%. For a company growing revenues 22%. The acquisition is also expected to create headwinds of approximately 25 basis points. Wow, 0.25%. To FY 26 subscription gross margin, so basically immaterial, a rounding error. Approximately 75 basis points to FY 2026 operating margin, a slight, less than a 1% dip in operating margin. And approximately 200 basis points to FY 2026 free cash flow margin. Hey guys, guess what? You know, if you want to increase your free cash flow margin, you could just make slightly smaller investments next year. While we will see some near-term headwinds to margins as we integrate the business, strong AI efficiencies internally Oh, they're being threatened by AI, but they're actually using AI to improve efficiencies. From now on now and our underlying platform leverage are expected to normalize our operating and free cash flow margin expansion trajectories into FY 2027. So it's going to come back in 2027. Now let's look at the horrible Q2 guidance. Okay, we just got Q1. Let's go look at Q2. Subscription revenues are guiding between 3.815 to 3.820, a 22.5% year-over-year revenue growth. Oh my God. Remaining performance obligations, 19% year-over-year growth. So they're still bringing in new contracts at a very accelerated clip. Their income from operations, they're guiding for a margin in Q2, a non-GAAP margin of 26.5%. That's an insanely high operating margin. Where's the issue here? So, of course, because of this slight headwind, because of a temporary conflict, the stock is down massively on the day, and it's been red over the past 5 years. Yeah, I'm actually buying more shares today. I am going to buy more shares of ServiceNow. So if we look over the financials, we're going to see how utterly ridiculous this overcorrection of Wall Street is. We can see revenue has been growing up and to the right consistently for the past 5 years. Revenue growth rates have consistently stayed above 20% and are actually re-accelerating. If we go look at profits, let's go look at profit margins. Gross margin is in the mid-70s. Oh, they may take a slight hit to that temporarily. Operating margin has been consistently growing over time. They are improving their margins over time. So even a slight headwind means absolutely nothing in the grand scheme of this company. Their profit margin has also increased, and their free cash flow margin is absolutely astronomical. You have all that together, and their share count is barely growing. They're issuing a little bit of shares, but it's not so dilutive that you're actually losing any significant earnings per share as a shareholder of this company. So let's see what an actual good buy point for this company is. So I'm going to pull up my tool here, and we're going to do a 5-year discounted cash flow analysis of ServiceNow using reasonable growth assumptions into the future. So the trailing 12-month revenue of ServiceNow was $13.960 billion. So we put 13,960,000,000. They currently have how many shares outstanding? 1.037 billion. 1.037,000,000. Okay, all right, so we have the basis in here. This is a 5-year discounted cash flow. Let's do some reasonable assumptions for revenue growth rate. Let's say they're going to grow their revenue at 17.5% over the next 5 years. That is extremely conservative. Extremely conservative. Go look at their historical revenue growth rate. In the 20s, and actually looks like it's reaccelerating. What is their projected profit margin going to be for the next 5 years? Well, if we go look at historical margins, we can see that it's actually been increasing over time, and it's hovered around 12%. But we'll be conservative, and we'll say it's 11.5%. Because let's say they take a little bit of margin impacts due to headwinds in the Middle East or some unforeseen events. What is their free cash flow margin? They are printing insane levels of free cash flow margin in the low 30s, but we'll be conservative and just say 30%. What is their PE at sale going to be? What will their price to earnings ratio be in 5 years? If we look at their PE now, it's trading at 50. Their trailing PE is 50, and their forward PE is 19, which is the lowest it's ever been in history, at least for the past 5 years. So we're going to be really conservative, and we're going to say somehow the PE stays at 20, okay? Price to free cash flow. What is their price to free cash flow at sale? Well, I would assume it's going to be roughly the same, trading about 19, okay? So we're going to put 20 there. What is their discount rate? What discount rate do we want? What rate of return do we want? I want a 15% rate of return in order to massively outperform the stock market. I am not going to buy an individual stock unless I can be assured of an 18 or 15% return minimum. So we're going to make our discount rate 15%. And then we're going to say that the shares outstanding change, they will probably initiate buybacks because of stock weakness. So we're going to say they're actually going to start a pretty big buyback authorization. So they're going to reduce their share count by 1% per year for the next 5 years. And we get an average buy point for a 15% return of $80.78. And this is with insanely conservative price to earnings multiples and price to free cash flow multiples. If we go back and we actually use normal PEs, if we use, let's say, 25 for a company that's growing revenues by 18%, and we do the same for price to free cash flow, guess what? According to this tool's calculations, buying the stock at $97.14 will give you a 15% rate of return over the next 5 years. I'm sold. Now, you can buy this tool yourself. You can buy it in the pinned comment below. It's $30. It's a one-time fee. It's your tool forever. You can do whatever you want. And if you break it, it's only $10 to replace it because I have to go and send you the tool again, and I'm going to get paid for that. You can buy this tool for $30. You can do whatever assumptions you want for whatever company you want, and as long as your inputs are correct, and as long as you're making reasonable assumptions about future prospects for whatever company, this can give you some insight into whether you would consider buying an individual stock or not. So I am 100% bullish on ServiceNow. I think the market is massively overreacting, and I am buying more of this stock today as soon as I close this video, as a matter of fact. Anyway, that's it. Like, subscribe, check out the discounted cash flow tool below. You can buy it yourself for a one-time fee, lifetime of $30, and I will see you guys in the next one.